Kooky, g'day, mate. This is a pretty important time. We're getting a lot of panic out there in the marketplace with all the media speculation that interest rates are going to go up again in August, the August meeting, off the back of the inflation number. And, we're getting this rhetoric about sticky inflation. We're getting quotes about the US system, etc. What do you think is going on, mate?
Yeah, getting back to why we've got this frenzied conversation, I guess, and the market's now pricing in a 50-50 probability of a rate hike in August, is that inflation number that we saw a couple of weeks ago, the monthly number, which showed annual inflation at 4%, was higher than expected. And it fueled into this feeling that maybe the RBA hasn't done enough to get inflation down. Now, couple of things that are really important in that. Why did we get to the 4%? And it's going to be the same suspects that get drawn out. Tobacco prices.
Tobacco and alcohol.
Alcohol, petrol, rent, insurance. Oh, and there was a little bit of travel this time. So there was a bit of a seasonal upturn in airfares and those sorts of things. So most of those things the RBA has almost no control over.
So putting interest rates up does nothing.
They're the reason, and they're the ones that have been increasing at 7, 8, 9% per annum and still are.
Yep.
When you look at things like food prices, the things that are more interest rate sensitive, clothes prices, car prices, they're weak. They're at or below the target range. So you've got this huge divergence within the CPI measures of what's still growing at 7, 8, 9. Or
building costs.
Yes, they're still going really strongly, and those that are back under control, like food. So where are we? So the RBA Deputy Governor, the new fella, Andrew Hauser, who I quite like, I think. I've seen him speak a couple of times. I think he's going to be an interesting fella. He said, look, don't get carried away with 1 month's numbers. We won't. So he tried to hose down that expectation. He said there's a lot more numbers between now, and this is his speech about a week ago, between now and when we meet in August, and we'll take account of the next employment number, the next retail sales number, the next building approvals, and what happens in the global economy.
And the next CPI number comes at the end of July, does it? When's the next
End
CPI?
of July, yeah, end of July, 31st of July.
The next quarterly and annual number.
They come out, the monthly, quarterly, all come out on the same, they're all simultaneously released.
Yes.
So that's going to be really important.
Yeah. So what is it that then is driving this speculation?
Look,
I mean, in terms of substance.
Yeah. To be honest, Mark, I've sort of had a good analysis of this sort of stuff. And I went through, well, I'm preempting our checklist here, but I went through what's happening in the economy. So, okay, I might be wrong and the rate hawks might be right. We might get a rate hike. I don't think we will, but so I thought, why might I be wrong? I looked at, and we'll cover this off later, GDP growth, weak.
Very weak.
Employment growth, slowing. It's still okay, but it's slowing. The unemployment rate is edging up. We had job vacancies numbers come out last week. They're down 26%.
That's
They've
mad.
fallen for 8 consecutive quarters. Demand for labour is coming off rapidly.
And also there's a lot of people getting fired. A lot of redundancies at the moment. Lots.
Yes, people are still clinging onto the jobs, but there are some sackings coming through
but
too. So
some of the big media companies have been putting a lot of people off. Some of the big telcos have been putting a lot of people off.
Telstra and others. You'll see that in the unemployment numbers in the next few months. It takes a little while for it to wash through the hard data that the ABS produces. But things like building approvals are still as weak as can be. They're poor. We look at things like one that we tend not to look at, and it came out yesterday, the Reserve Bank Index of commodity prices. Okay, when commodities go up, it's great for Australia because we're a big commodities producer. When they go down, okay, we have a bit of a hit. And it's linked to the Chinese economy, which is really weak. Their interest rates at an all-time low. Their stock market's looking crap. The RBA Index of commodity prices is down over 20% over the last couple of years. The iron ore price has gone from 140 odd US dollars a tonne to 105-ish. So it's still okay, but it's the direction that's starting to get me worried. So I was looking through this list, as I said. I can't find anything other than inflation that's sticky, strong, persistent, turning up. I can't find anything that's strong. And
Could I ask you a question then, Steve?
I don't know what's causing this rate hike expectation to be so frenzied.
If the RBA is looking at one thing alone, inflation. Let's say inflation stays at 3.5%.
Yep.
In other words, we'll talk about this in a second. But just say it comes at the end of July for the last quarter, and the annualized number comes at 3.5%. It's not good, not bad. it's okay. It's acceptable. But let's say GDP is minus.
Yeah.
Let's say that unemployment goes up to 4.3.
Yep.
At what point does the RBA say, hang on a minute, our job is about growth and prosperity, or prosperity of all Australians,
Yes,
and welfare. But right now, the inflation, the welfare side, the inflation bit is not so high that we are really.
Sorry.
That's right. It's not so high that we're really concerned about the welfare of Australians. In other words, those people who are adversely affected by inflation, relative to our prospects for prosperity and growth. Do they sort of rebalance their thought process? Because we just keep looking at inflation, and all the media keeps looking at inflation, but they're forgetting about GDP and they're forgetting about unemployment.
Yeah. In fact, the number of articles that are the hawkish ones, I'm doing a little bit of a cheeky survey. Half of them don't mention unemployment.
Never.
And the dual mandate of the RBA. Remember, we've spoken about this in the past. The Treasurer, Jim Chalmers, for what it's worth, did a revamp of the RBA
last
year ago. Yep. And part of that revamp is that, yes, the inflation target is really important. So I'm never going to disagree with that. But so too is the unemployment rate.
Full employment.
Full employment.
Yeah.
So there's not so while there's a 2 to 3% a target for inflation, there's not a number for full employment. But
we have one.
You can see, we discussed this the other day. Yeah. You can sort of see that as this unemployment rate's creeping up, and yes, it's not zooming high at the moment, but as it's creeping up, you're seeing wages growth just starting to come down. Enterprise bargaining agreements. There's some data that just came out the other day showing that wage agreements are only sort of 3.5%, which is fine, which is not inflationary at all. So you've got this sort of situation where we do have to look at the labour market. And that's what, again, the Deputy Governor of the RBA was saying a week ago. The labour market is really important to us. So your question, if inflation comes down but doesn't quite get to the target range, GDP's really weak, negative maybe, and we get that unemployment rate creeping up, what are they going to look at? I think we'll have this focus shift towards the unemployment rate, because nobody wants the unemployment rate to hit 5%.
So for me, those three elements, and they're always at the top of your list here, but GDP, inflation, and labour markets, which is, GDP, which is the measure of growth in the country, which is a really important part of the mandate for the RBA. Inflation is the thing that they're sort of zeroing in on all the time. We keep hearing about 2 to 3% target. Be different if we're at 7%. We're not. We're 2 to 3. We'll be, let's say, on our hypothesis, let's say we're in the mid threes. But if unemployment, which is a new emphasis of the RBA, directed as directed, as reviewed, and by an independent body, and directed by the Treasurer to the RBA, the new governor and the deputy governor, and everybody else sitting there. At some stage, there's going to have to be a rebalance of the rhetoric. So, and maybe even the deputy governor is now actually starting to put a bit of emphasis on that rhetoric. If anything, it may indicate to me, in terms of the direction of the GDP and labour market, the way they're going, if anything, I think it's going to be something that will stall any interest rate rises. Yeah,
I think that's a great summary, because the job vacancies that we mentioned a few moments ago are pointing to, and the correlation between job ads and unemployment has been the same for 25 years.
In other words, the higher the more demand on the more job ads that are being put out there. In other words, the more employers need staff. There is a correlation between that and low unemployment.
Low unemployment, correct. And so this 26% fall that we've seen in job vacancies, and there's a lovely chart, I'd have to find it somewhere, I might email it through, that shows that if that correlation holds, and it will. Economics, the rules of economics haven't broken down.
Yeah.
There's just either a little bit of a lag, or there's a few data quirks in how the Bureau of Stats are measuring things. It's actually consistent with the unemployment rate getting close to 5% from the current 4% and the 3.5% that we had a year ago.
Not even a year
ago. And when you think about that, and this is the thing that, I don't know, I've got a bit of a humanitarian side to me. Okay, 4.5% unemployment from 4%, that's another 100,000 people. Yep. That's people that we're talking about, and their families and all the rest of it. So, and that's why we have the RBA having an elevated mandate towards the labour market. We don't want unemployment. Gosh, I remember the early 90s recession. We had unemployment and the economy was much smaller back then. We had unemployment hit 1 million people
We had that at the beginning of COVID.
It was yes, we did temporarily, but thank goodness for JobKeeper. JobKeeper. Thank goodness for that. That was one really good thing that Josh Frydenberg did.
But we actually did have technically unemployment of 1 million people.
We did.
They still getting paid. That's
They're
all.
still getting paid even though they were sitting at home. Yes, but we've called it the real recession. The horrible recessions are bloody horrible. Genuinely unemployed, and you couldn't find a job for love or money because there were no job ads. Businesses were closing. They were not only not hiring, they were sacking people. So that's what the Reserve Bank. That's one thing that we learned from economics. One thing about economics is that sensible people learn from what went wrong in the past. And that's why when we look at the global financial crisis, 13, 14, 15 years ago, and the pandemic, the stimulus measures that were put in place, one by Labor, one by Liberal. So we've learnt were actually both really good policies. Yeah, there were a few little wrinkles that they probably gave a bit too much here and a bit too much there. But at the end of the day, they were the right things to do. And they got Australia through this troublesome spot. And here we are. So the lesson that we're learning about high unemployment is that the social consequences and the economic consequences are really bad.
So do we run a risk? Let's say, for example, this would be going through the Reserve Bank's mind. Do they run a risk, and therefore we run a risk, if they do put rates up in August, the August meeting, and let's say by 25 basis points, do we run a risk that that horrible thing called stagflation could hit us?
Yeah. If they put rates up again, that will be that proverbial straw that breaks the camel's back for a lot of people. We're already seeing some insolvencies starting to pick up, particularly in the small business sector. And that's a concern. So another 25, 25 in itself is not much, but you've got to remember that's on the back of 425 points of earlier rate hikes. So it's yet another blow at a time when the economy's weak already. So it does. I don't think it'll actually cause stagflation as such, because I think inflation's coming down.
No, but I'm worried.
You'll have a crappy economy, but that crappy economy will actually speed up. Well, in theory, speed up the direction of the falling the falling inflation rate when we get those numbers late this year.
So it would work.
Oh, and I've had this conversation, Mark, and I think you'll appreciate this. Some people say, maybe we should cut spending and have a budget surplus all the time. Look, the government could deliver a budget surplus of $100 billion tomorrow if it wanted to. Let's cut health, cut education, hike taxes by, bloody 50%. They'd have a budget surplus. But it would decimate the economy, which is why, thankfully, they don't do it. We could get inflation back to 2 to 3% almost tomorrow if the RBA hiked 200 basis points tomorrow. Within a couple of months, we'd have inflation down. But the costs are so great. And I think that's the thing that I'm screaming whenever I get the chance, that, we are going to get there. Be patient. That the momentum, as I said, the rules of economics still work. We've got 1.1% annual GDP. That's shocking. The last quarter was 0.1%. Unemployment's going up. Wages growth is starting to top out. When the rules of economics work, inflation will come down. It's just not happening as rapidly as some of us would like. And so maybe we just need to sort of take a bit more of a time out and allow it to kick in and allow that inflation rate to come down.
Can we just shoot a hole in something that's really pissing me off that I keep reading about, like just literally every day, every other day anyway, and that is perhaps we should be getting our cash rate up to closer to what the US has got, which is like more, what is it,
5.5.
Yeah. So, we're only 435, but the US is 525, 530, whatever it is. It's got a 5 in front of it.
Yep.
We should be closer to them. Let's just shoot a hole in that straight away.
Yep.
Like 95% of the US mortgage market that gets affected by interest rates is fixed.
Yes.
So most of those people have got fixed rates going back last year, the year before that.
Yeah. Not impacted at all.
30-year fixed. Not a 2-year fix or 3-year fix or 5 years. Fixed for 30 years.
Yes.
So they're paying extraordinarily low interest rates. And so the interest rate regime doesn't change their position at all.
And I'm sure my mate wouldn't mind me talking about this. I've got a mate who lives in the US, in New York. Chat to him every month about life and economics and all the rest of it. And he made that very, very point. He and his wife, they bought a place, 5, 7, 8 years ago, whatever it was. They refinanced at the low point during COVID for 30 years at 1.8%. Yeah. And he said, mate, the rate hikes haven't impacted me at all.
And that's most Americans.
And that's the vast bulk, as I said, 90-something%.
Yep.
And the only way that you then go into the new interest rate environment is if you're taking out a new loan. So if you're refinancing, so if you move house, which if you've got that mortgage, you wouldn't do. So that's why people aren't moving
unless
in the US.
Unless you bought a new joint.
Unless you moved cities or you bought a bigger house or downsized, which is why people aren't moving, because I've got this terrifically low interest rate. And so in Australia, though, and here am I talking to you, you know better than anybody, when the RBA moves interest rates, within a week or two or three, it's passed on to 90% of borrowers who have a variable mortgage interest rate.
Well, right.
So that 25 points, oh, damn it, I'm paying $50 more. Oh, another one, another $50. Oh, another $50. And so that cumulative effect, or if they go 50, which they did a couple of times in 2022, there's a big chunk that's passed through really quickly. That's why our interest rates haven't, nor do they need to, go anywhere near what they've done in the US.
And what's interesting about that is that we're the actual direct opposite to the US. If they're 90-odd% of people and they're having fixed for 30 years, we're 90-odd% who are variable. So it basically changes every single month.
Every single month. If the Reserve Bank adjusts official rates,
change.
It's passed on to you next month or later the same month.
And on the way up, that has a massive impact on people.
Yeah.
But I think it takes some time to accumulate.
Yeah.
And my gut feeling is it's now reached its accumulation phase.
Yeah, as I said, the straw that breaks the camel's back.
Yep.
When the cash rate was 0.1% two and a bit years ago, and mortgage rates were 2 point something, let's call it.
2.1 they were.
The first couple of rate hikes, people thought, oh, whatever, it doesn't matter, because they were just ridiculously low, and people realised that was not the new norm. You know, it wasn't 2% mortgage rates. My God, that's stupid. So the first number of rate hikes didn't really touch the sides. You know, that people thought, oh, damn it, I'm paying another few $100 a month, but I'm still okay. Then the point comes, the slow accumulation of these rate hikes got to a point where they are starting to bite. And that occurred, again, the other thing, Mark, don't forget, it occurred when the cost of living pressures were very real. When wages were only growing at 2.5%, a couple of years back, inflation got to 8%. So the cost of my groceries, the cost of my insurance, the cost of my petrol, the cost of all these things has gone up. So not only were they forking out many, many hundreds of dollars more on their mortgage, they were forking out a whole lot more just on
everything else,
on your essentials, your food and groceries and your rent and your electricity and all these other things. And that's where people came under so much pressure. And I'll just circle back to my other favourite indicator. I've got 100 favourite indicators. Consumer sentiment. Because consumer sentiment measures how optimistic people are. Is it a good time to buy a major household item? What do you think about your personal finances? All this sort of stuff. So it's a really good survey. And consumer sentiment has been around 80 index points. I'll just explain this for 30 seconds, for more than 2 years now. Now, when the index is at 100, there's as many optimists as pessimists. When it's above 100, we're all optimistic. We consumers collectively are optimistic. It's been 20% below a neutral level for 2 years. And when we consumers are pessimistic, we keep our wallets closed, we change our spending, we obviously we've got to buy essentials by definition, but we cut back on discretionary spending. And that's exactly what's happening. And the consumer sentiment numbers that came out this last week or two have been rotten.
So when they do, explain this to me, when they do, inflation is all about how much it costs for me to live. So, really at the end of the day, what they're trying to do is make sure my cost of living, by virtue of the impact of inflation, is allowing me to maintain a certain standard of living. It's not going up at such a rate that I have to start dropping some things out of my life that are a good add to my standard of living. There might be, netball. I can take my kids to play netball. I can take my kids on a holiday to Fiji once a year or twice a year. These are all things that indicate my standard of living as a measurement. Inflation is one of those things that helps that, and cost of living is where inflation gets measured from. So, in other words, costs of various inputs of goods and services, the increase in those things will affect the new cost of living. Tell me, what I think one of the greatest contributors to the cost of living is the amount of money I'm paying on my mortgage. For that 1/3 of the population has a mortgage, but it's not included in the cost of living analysis.
Rent is.
Yeah, I was going to say rent is for the other 1/3 of the population who rent.
Yep.
just explain. I mean, is there some logic why the cost of living isn't
the
repayments on a
mortgage-
loan is not or the interest rate is not included?
Yep. There is. And the reason is, and it's not a bad reason to be honest, that if you included it in rate hiking cycles, it would compound
Make it
the
worse.
upside side in inflation, and on downs it would compound the downside.
Yep. So it's distorted.
So it's certainly in your cost of living, but it's not in the consumer price index that the statistician produces every month and every quarter. Now,
But rent
that
is.
Rent is?
So the cost of accommodation when it becomes rent is, but if a cost of accommodation comes to interest, isn't.
No. And that's an issue in terms of how people are feeling.
That's just more important.
It is, because people spend more on their mortgage repayments than they do on rent because they tend to be bigger. So, I'm generalising big time here, but it tends to be young people on modest incomes that tend to rent. People with a mortgage tend to be middle to high income earners. I'm generalising, and they borrow more and have a higher proportion or the same proportion of a higher income servicing a mortgage than a renter. I'm generalising, but it's generally the case. So, but we're getting back to this sort of question about which is the best measure of inflation too. What should be in and what should be out? I've had conversations with people, well, I don't smoke. I don't know anyone who smokes yet. We've got cigarettes in the consumer price index. Well, 10% of people do smoke, and the inflation rate is what the average household eat, drink, smoke, consume. Insurance services, rent, petrol, holidays, education services, you name it.
Even if I've got an electric car, though, I still get it.
The petrol's still included in the CPI, yes. And even if I
Don't drink.
own my own house, the rent's still in the CPI. And I don't drink alcohol, it's still in there. I don't get takeaway meals, it's takeaway foods in there.
Is it fair to say,
I'm a vegetarian, meat's still in there.
on a per person basis, it's actually inaccurate?
And this is the issue that the statistician has. And the other thing too, Australia's inflation measurement from our friends at the Bureau of Statistics is the same methodology as all the other major countries. So they all, because Americans and Kiwis and Canadians and British people have different weightings in what they spend their money on. That's fine, but it's the same methodology. So if, I don't know, British people spend more on energy because it's colder, I don't know, just made that up, than we spend because we tend to have better climate here, they'll have a higher weighting on electricity than we do in our consumer price index basket. So there are differences, but the broad theme, and every year the Bureau of Statistics does a survey of what we spend our money on. They know how much we spend on all of those. I think it's up to 100 main items.
91.
I think it might be 91.
It was 91.
I'll have to check that. It's probably
Might have increased, but
almost
I
100,
recall it's 91. But
yeah, okay, you're right. And then they weight them. So if the average Australian spends 3% of their income on petrol has a 3% weighting. If we spend 1% on tobacco, 1% weighting. If we spend 0.7% on lamb and beef, that gets that weighting in the consumer price index basket.
So, but by definition, it's sort of a bit inaccurate. Or it's a bit of it's a fiction. It's fictional.
Yes, it is. It is only an estimate.
Yeah.
And it is, and I don't think there would be any household in Australia that consumes exactly that proportion.
Correct.
So, because guys say, oh, well, I don't smoke, so why are cigarettes in there?
Well, let me tell you the next step then.
And I don't pay for education. My kids finished school ages ago, so I don't pay any money for education, but it's in the basket.
Well,
other people do.
Let me tell you the next step then. So, as a result of this fictional, slightly inaccurate, or whatever, but statistically well put together in a quantitative analytics basis, like a proper mathematical sense, as a proper formula. Off the back of that, the Reserve Bank responds.
Yes.
With interest rates.
And that's what they target.
But if one could be forgiven for saying, this is all bullshit. And then off the back of that, the media then goes to town and puts pressure on people, and house affordability, which is a direct response to how much it costs to borrow money, gets out of control.
Yep.
And some people miss out on houses altogether. The whole thing, I mean, I don't want to be the person who sits here and undermines what the government does, because government's about governing, and governing is about controlling outcomes. We don't want to spend too much. We don't want to spend too little. We want to spend just perfect. But to do that, we need to have measurements. If you can't measure it, it's not worth anything, whatever the saying is.
Target it, yep.
Whatever. It's got to be measured. Everything's got to be measured in our world. Everything's got to be measured. Go to the doctor, wants to measure cholesterol. Everything's got to be measured, okay? So we're going to measure it, and in terms of measure, we can't actually work out what every single Australian spends on petrol, and we can't work out what every single Australian spends on coffee or whatever, or meat or lamb, or it's just not possible. So we send a field officers out and we ask questions, and as I recall, it's like 20,000 or something. It's not a very big sample, but it's statistically relevant in terms of being able to get the right outcome statistically. But all of a sudden, the whole thing, we're all sitting here hanging on. Shit, are they going to put the interest rates up in August? What's the Reserve Bank going to say?
Because tobacco prices went up.
Yeah, or what the hell?
Lettuce prices went up.
Yeah, or school fees have been, or tertiary education went up at the 1st February.
Yeah.
So that's included in the latest inflation number.
It is, yeah.
Because it's in the last 12 months.
Yeah.
And it went up by 6% or something.
Yes, it was a big increase. And private school fees are in there.
As well. So, but all of a sudden it becomes a bit of a nonsense, Steve. Help me out here.
No. If the Reserve Bank and the Bureau of Statistics were sitting here instead of me, they would probably say it's the best we've got.
Yeah.
And I do agree with them, it is.
I don't have a better outcome, by the way.
No, they do know, and particularly with modern technology, they know the price of petrol every day, every minute of the day, basically. They know the price of socks. They know the price of everything that's in the consumer price clothes and in the consumer price index basket. They know it exactly because of... they measure it and they just actually physically, well, how much is a haircut?
But they've also got access to the banking system too.
They do.
And the banks, banks know from credit cards how much people are spending.
And they know that. So they say that we can't, in theory, what you're almost saying is that you should have a different interest rate to me because you spend more on that and I spend less on that, and you need to cut your spending, Mark, because you're spending too much. You're adding to inflation.
Yes, that is sort of my point.
So, Mark, you need to have 10% cash rate, whereas... young fella down the road with a low-paid job,
I understand
they should have a low interest rate.
I understand it's not possible, but I'm just saying that is...
in theory it's correct. It's popped up every
It's more fair.
In theory right now, and people talk about this on Australia, our wonderful federation, good old bloody Australia. WA right now should have a much higher interest rate than Tasmania. The WA economy is booming. Their house prices are going up 20-something% in annual terms. Tassie, house prices are dropping. Their economy's in trouble. Yet the Reserve Bank, when it sets interest rates every meeting, every 6 or 8 weeks, sets the same 4.3% cash rate, whether you're in Hobart or in Perth.
Yeah, for everyone.
Everyone. And so I don't even want to talk about the euro and the advent of the euro all those years ago, but that's the sort of one of the problems that's created within the eurozone, where Germany has the same interest rate as Greece or Italy and Portugal and France. They've all got the same interest rate. It's a problem when they gave up their sovereignty over their own monetary policy and their own currency. So you've opened a can of worms. It's a good can of worms, as it's what do we call it, academically. A really hot issue, but practically, there's not much you can do. You still got to have one rate for the whole country. Okay,
so that takes me right back to the beginning, and I often talk about this. The RBA actually does not know. So what we're settling on is the RBA is going to act on data, whether it's accurate or not, or complete and accurate or not. It doesn't really matter. It's going to be based on data, and it's going to be something that applies to everybody. But the RBA, therefore, do not know whether in the August meeting, whether they'll be putting interest rates up or down or sideways or doing nothing at all, because it'll completely depend on what data comes out at the end of July. Yep. And they don't know the data because the data hasn't been produced yet.
Correct.
And if they come out and it says 6% inflation.
Oh, if we had a shocker like that and the unemployment number that comes out in 2 weeks was 3.5 and something happened to the global economy.
Yeah. And GDP comes out at 4%.
Yes, which is all...
Yeah,
I never say never, but no, I get your drift. If they all came out, the Reserve Bank could hike, of course they would. So they should.
But mate, the RBA doesn't really know today.
No,
so people sort of say, and the media is talking about it, but if the RBA doesn't know, then how the hell can the media be talking about it?
Correct. We can speculate about it.
Because it's just mere speculation.
Have to invest their money But you sometimes get it wrong. Well, look, Mark, I've been wrong.
No,
Quite
I get it
often
wrong
on my forecasts.
Same as me.
It doesn't mean that my views are hopeless, because you analyse things and something comes out of left field. Just as the people forecasting rate hikes now, I read them with a lot of interest because they're smart people, unambiguously. They're people with, gee, why are you forecasting rate hikes and I'm not? What am I missing out? I learn from that experience. And then I still disagree with them at the moment because they're putting a bigger emphasis on, the US interest rates versus Aussie interest rates, that sort of stuff. And I disagree, as we just discussed. So the question is for the Reserve Bank. And this is why when Michelle Bullock has given her press conferences after rate decisions in the last 3 or 4 times she's done it, she said, for future meetings, I'm not ruling anything in or anything out.
Yeah, up or down.
So at this stage, because the journalists, like
they're trying to trap
dog
her
with a bone, trying to say, oh, you're going to put them up or put them down or whatever. She says, look, I'm not ruling anything out. And just as you said, we will watch how the economy evolves. And when we get that information, we will then make a decision on whether to put them up or down. So we're not ruling putting them up. We're not ruling out putting them down. We are waiting to see what the data shows us.
Which is why your board, which you're going to get to now, but why your board is so important, because really what we're saying here is, look, consumer, or anyone who's happened to be listening to this, don't worry too much, read as much as you like, but don't worry too much about what the commentators are saying. At the end of the day, the Reserve Bank is going to make a decision based on the data that's going to come out at the end of July. The question then becomes, what data?
Yep.
What data they're looking for?
Yes.
And the data is, the 3 big ones are GDP, inflation, and labour markets, which we're going to go to now. And where does a consumer find this information? Well, they can be there on the end of July, on the moment the thing comes out in the abs.com.gov.au, and they can see it at the same time the RBA sees it.
And it changes everything. It can change everything.
Correct. And
it has in the past.
So our job is to say, what are the 3 biggies that the RBA is looking for?
Yep.
We're going to look at it in a minute. Yep. But also, what's the range? What number does the RBA want these 3 biggies to fall on? Yeah,
that's a really good thing. And this is the thing. We sort of have not a perfect, but a pretty good idea the day before the RBA meeting what they're going to do. But this far out, a month and a bit away from the board meeting, we don't know. Because as we get, I can't remember the order now, retail sales, tomorrow or the day after, we get the labour market numbers. We get business confidence numbers. We get the inflation numbers. We see what happens in the world economy. Oh yeah, that fills in the jigsaw puzzle for August meeting of the board. And this is where, and look, I make these forecasts where people say, oh, what's your view on official interest rates in a year's time? Oh. Look, you make an educated guess, fine. But if the news comes out one way or another, and this is, I try not to bring this up too often, but Dr. Lowe, when he was governor, no rate hikes till 2024. He said that in 2021.
Based on that day's data.
Based on that data, but things changed.
Yeah, rapidly.
Without being critical of him, because what happened was that when the vaccinations allowed us to go out again, we weren't locked down, we got good savings. Gee, interest rates are low. We went and spent like crazy. Inflation shot up. There were supply chain problems around the world. And so he was wrong. Again, we were all, most people were wrong because the way the economy reacted was unforeseen. Nobody, I'm not aware of anybody who forecast in 2021. People were saying, they probably need to hike 100 points. No one was saying 425 points.
No way.
Not a chance, no.
No way. And it's all very convenient how clever everybody is after the event.
Yeah.
Let's look at the chart thing, especially the top 3, because they're really important.
That's
why this chart's so important to us.
Owning your own home should be an advantage, absolutely not a burden. But for too many Australians, the dream of home ownership has become a struggle. And that's due to the rising cost of living pressures and, of course, high interest rates. So at Yellow Brick Road Home Loans, we want to do our bit to make a difference and tackle this housing crisis head on. That's why we're putting out a call out to all Australians to join us in helping their mates, whether they're thinking of getting into the property market or just want answers on their own current mortgage. So refer a friend or a family member who could benefit from a closer look at their home loan options to speak to an expert Yellow Brick Road mortgage broker, and you'll both gain an entry to our $40,000 Help a Mate giveaway. At the end of this campaign, my team and I are going to randomly draw out one of two $20,000 prizes split evenly. That's $10,000 each for the winning referrer and their mate. But if you want to enter by yourself to help out with whatever you like, whether that's your bills, first home deposit, or your mortgage repayments, we've always been here to guide you down the road to home ownership. And now we want to extend that guiding hand to your mates. To enter this giveaway, head to ybr.com.au/mates. Let's spread the word and help our family and mates achieve their dreams of home ownership. Head to ybr.com.au/mates and share yours or your mate's story to both go into the running. And good luck with that.
Right, Koukie. So what's really important here? We got our board here, your board, but just give us context again. So the context, why we do it like this, why you do it like this, and particularly in that order. You know, you might change the top order, the top three around. Everyone's got a different view, but GDP, inflation, labour market, or unemployment, full employment. Why those three things are so important relative to the RBA? We just talked about it, but give us context again.
Well, the RBA has a target for inflation, 2 to 3%. What drives inflation going up above 3 or below 2, or staying within the target range? It's the rate of economic growth, GDP growth. You know, that Goldilocks, not too hot, not too cold, but just right. And the labour market's really important. So if we have a labour shortage, skills shortage, wages go up, you're a business person, how do you recoup your higher wages? You put up your prices.
It's called cost push inflation.
And that's high inflation. So that's what they look at. These other things are really important. You know, the RBA does look at retail sales and these other things, which we'll touch on in a minute. But it's really this. And of course, they all go into GDP. So there's sort of a little bit of an overlap on some of these. But at the end of the day, it's really these top three, maybe wages, which sort of fits into the
So give me a bit of an idea. What would the RBA looking for in GDP as a number?
If they could grow the economy, this is sort of like potential GDP growth. It moves a little bit according to population growth, a few other bits and pieces, but around 3% would be, given our population growth, would be what would be the ideal. That'd be the soft landing, not too hot, not too cold. So if our GDP was in annual terms, expanding at 3% per annum, the RBA would say, yeah, good, we're happy with that. We don't have to adjust interest rates because we've achieved a sustainable, non-inflationary rate of economic growth.
Okay, so let's look at GDP. So when you move the GDP button...
Putting it all the way in easing, Nate.
Right, so currently we're looking at
1.1% annual growth.
Right, at 1.1, off the back of a 0.1
in the quarter.
In the last quarter.
Yep.
Which was the March quarter or the December.
That was the March quarter. We had 0.1.
So, what GDP number do you expect to see? Sorry, what GDP number should punters be looking at in the next GDP print?
Yep.
That would indicate to you either the interest rate is going to go up or down or stay the same.
Look, and the thing about the building blocks of GDP, if I can answer it this way, through the course of the quarter, because GDP numbers are quarterly, so we haven't got the June quarter, it only just finished the other day, but we have the building blocks. So we get retail sales, which feed into GDP. We get building approvals, which feed into GDP. We get exports, which feed into GDP. So we sort of have a bit of an educated guess as the quarter evolves. Because we've had such a miserable starting point for GDP, the 0.1, even if we got a plus 0.6 or 0.7 GDP for the June quarter, which I don't think we will, by the way, I'd still say that's erring on the side of easing. And indeed, I was actually seeing, various economists, my mates in money market economists, they're all saying that GDP is going to be, again, close to zero. It might be 0.1, 0.2, but that'll just see the annual rate drop below 1%. That's miles from our 3% target, if you like, for GDP that the Reserve Bank would like to see. So if that was the only thing the RBA was looking at, they'd be cutting interest rates now.
And going back to the mandate, growth and prosperity of the nation.
Growth, yes.
Because that's how we measure it.
Indeed. And this is the other thing. This is the thing that gets a lot of media coverage, and this one rightly so, is per capita GDP, which is a measurement of our improvement in individual well-being.
Which improves our standard of living.
Correct.
Or informs us of the standard of living.
Standard of living. So if per capita economic activity is going backwards, on average, each person's well-being is going backwards.
Correct. Our standard of living is dropping.
And if we think about the last 30 years, up until the pandemic, let's just use the pandemic as a endpoint. But from, say, 1992 to 2020, roughly, we had GDP growing at that 3%. We had population growing at roughly 1.5%. So 1.5% per year, compounded for 30 years, made Australians really well off. It was great. We could afford to have a good healthcare system. We could afford to have the NDIS, and without getting into the nitty-gritty of all those sort of things. We had prosperity in our housing markets. Australians were well off. The risk in the last couple of years is as per capita GDP has gone backwards for 5-6 quarters now, our living standards are starting to decline. That feeds back into the consumer sentiment number that I was talking about before too. People are feeling under the pump.
And for me, given the mandate of the RBA is a number of things, including unemployment or full employment, it is also about inflation, it is also about currency, but it's also about prosperity and welfare. Welfare is an important one. But for me, RBA, you're not serving us well on the prosperity piece. If I use the traditional measurement of GDP.
GDP's
Sorry,
weak.
it's not working.
Yep.
And it hasn't worked for a long time on a per capita basis. And they should be talking about per capita. Please stop talking about the total number.
Yes, it has to be per capita.
It has to be about per person.
Even when it's up or down, yes, and indeed, more people are starting to do that.
But
Mark,
they never. But RBA does not.
No, they don't like it for some reason.
I don't know what the deal is.
Probably because it tells them a story that they don't want to tell, without wanting to be too cynical.
But it is their job. I'm sorry, it's not just about inflation, and because inflation to me, Steve, is only informs me as to welfare, because inflation is a problem. They keep talking about inflation as a problem. I agree, it is a problem for people, especially in the lower socioeconomic, because their cost of living has gone up relative to the wages. Their standard of living has gone backwards much more than everybody else.
But about 8 or 10%.
But if everyone's standard of living has gone backwards, then there's got to be some balance in it. That's a mining point. I'm not going to go further than that. Inflation, what are they looking for?
Okay, inflation I'm putting in the neutral to tightening. As we said, 4%, we want confirmation that inflation rate's coming down. So that's where the people who are speculating about rate hikes in August and maybe beyond, some people are saying 2 or 3 more rate hikes, my goodness.
My God.
Whew, I've got to just sit down when I hear that, is because they reckon inflation's, I hate the terminology, sticky, persistent. The 4% will only go to 3.5% and it won't come any further, and the RBA's got to keep fighting it. So I can understand the argument. I disagree with it for the reasons that you just mentioned 60 seconds ago. The economy's weak, and that relationship between economic growth and inflation is still there. And the only thing, and there's been, tens of thousands of academic exercises on the link between economic growth and inflation. And this is where some people might hear the phrase long and variable lags. So the time it takes for a weak economy to impact on unemployment, it takes between 6 and 18 months usually. So that's why we see the labour market being the last thing to change in the economy. GDP first, then inflation, then the labour market. And indeed, I remember we've had jobless recoveries. Remember, the economy's recovered. Unemployment's still high. Why? Because firms aren't willing to hire people just yet. So that's in the tightening to neutral side, because we do want that inflation rate to come down, or the RBA wants it to come down, I should say. Labour market, putting that in neutral, because unemployment at 4% has gone up from 3.5%, as we mentioned. But 4% is still nice and low compared to the last 50 years. It's a good thing. And let's embrace it. Sometimes in economics you get lucky, or there's a good policy decision that's taken. And I'm an optimist at heart. I love low unemployment. I like to see my fellow Australians with a job, earning money, and from an economic perspective, adding to the economy, as well as adding to their own personal status and their well-being and their financial well-being. Full employment is a mighty good thing. You just have to look at countries where there's unemployment rate of 10% and see how, there are social issues, crime issues. I want full employment, So I'm happy with 4. I'd be putting that towards easing if we get to 4.3, 4.4%, and the job vacancies numbers, which I mentioned before, keep tracking.
So that's what the punters will be looking out for. The next unemployment number.
Unemployment number is arguably
north
as
of 4.
important as the inflation number. could be more important as we get through the second
If it gets
half
north
this
of
year.
4, we're getting closer to easing. If it's sub 4, look
Yeah,
out.
if it's up for the rate hiking, folk might be right.
Yep.
If we get back to 3.8, 3.7, something like that. Wages is in neutral. We mentioned that wage price spiral. Interestingly, the wage price index, which is the measure that the RBA likes most, so if they like it, I like it. The last 3 quarters of the wage price index have been 1.2, 1.0, 0.8. So as the labour markets softened a bit, the wage momentum has topped out. And so we've got this situation where in annual terms, and I looked at the RBA forecast, Treasury forecast in the budget, what was that, 2 months ago now, for wage growth about 3.5 to 3.75. That is perfect. If we can achieve that, that'd be great. The risk is that the weakness in the economy causes the labour market to weaken, and all of a sudden that good news on a little bit of wages growth starts to turn sour. But at the moment, 3.75 wages growth, that's pretty good. It's neutral. No one's going to be too worried about it. International economy, I'm putting on the side of easing. I've actually done a bit of work on China. China worries me. Mark, I did something the last 48 hours on China. Their economy is way below trend. Their interest rates are at an all-time low. Their stock market's looking like crap, to put it bluntly. Their commodity prices, which are quite different to other commodity prices because they use a lot of iron ore and coal and these sort of stuff, have fallen 20%. So I'm worried about China. And we still have rate cuts being priced into the US, the UK. Well, Canada and the Eurozone have already cut theirs. And again, I don't think we're talking multiple hundred points of rate cuts, but there's rate cuts occurring. There are rate cuts occurring around most of the world right now. We will be part of that. We're seeing commodity prices starting to come back down as a signal of what's happening to global inflation. So that's just erring on the side of the easing for the RBA. Remember, this is the RBA.
Yeah, they seem to want to go in lockstep with the international economy.
They do. And on the way up, Mark, this is the other thing. Again, we didn't move one for one with the US or the UK, and none of them moved in lockstep with each other anyway. But you look at a chart of interest rates in those countries, the US, Europe, UK, New Zealand, Canada, they're all up, topped, and they're just starting to come down now. So we'll be part of that.
Yeah.
And so is the RBA.
Yeah.
So we'll be part of that. We're debating when's the first one, how many cuts there'll be, and all that sort of stuff.
But we're
that's a global
like about
conversation.
6 or 7 months behind everyone before, maybe more.
Yeah.
Maybe we might be behind 6 or 7 months behind them as well this time.
Could be, yes. Well, and that's the debating point, or the point that the RBA is going to be looking at. House prices, we haven't spoken much about house prices. They're resilient. We touched on the fact that Perth prices are up 22% year on year. Hobart, small negative. But of course, the RBA doesn't have any different interest rate
They
for
take an average.
Tassie and WA. But house prices are about 8% year over year. Probably a little higher than the RBA would like. Not that they target house prices, but there is a wealth effect, and there are other things that come from house prices, particularly after they've been very strong the prior period. But 8%, they're starting to cool off a little bit. Melbourne's weak. Sydney's starting to cool off a little bit. So maybe the lagged effects of the rate hikes, the rising unemployment rate, we'll see house prices weaken further. So I'll put that in the neutral case. These two move together. Retail sales, consumer sentiment, which we did talk about. My goodness, Mark, I don't know how many retailers you speak to in your day-to-day work. I speak to a lot too. I look at the hard data from our friends at the Bureau of Statistics. It's rotten. Really tough for particularly small, medium retailers. The big guys are probably okay. They've got the bulk turnover, brand loyalty, all these other things. But if you're competing with one of the big guys, if you're a small and medium retailer, you're under a lot of pressure. A lot of the retail companies that are listed on the stock exchange, their share prices are coming down. Investors know what's happening, let alone the small business sector. So retail screaming for a rate cut. Building approvals, same boat. We're not building enough houses. We've had this conversation for a year. We need to build lots of houses, good for GDP when we're building them, good for the housing supply to address the rental shortage and the dwelling shortage because of our strong population growth. But at the moment, we've got building approvals tracking at an 11-year low. The government wants us to build 1.2 million houses over the next 5 years. I'm a betting person. I'd be willing to bet a lot of money that they're not going to build 1.5
Well, I bet they won't
houses.
even make half.
Well, they might, but there's no way that we need to build houses. So they're trying to fast track, rezoning and these things. But, property developers aren't going to make it, build more houses while interest rates are where they are, while planning's so cumbersome, while they're having difficulty with costs.
It's also the
materials costs
taxes
and labour costs.
It's the inputs.
Yep,
The
all
inputs are
that stuff.
ridiculous. A lot of the developments don't make sense.
Correct.
Economic sense at the moment.
That's a problem.
And the developers just sit on it.
The thing that's, again, okay, and those two go together, business confidence and business investment. Business investment's okay. There are some catch-up, if you like, from the COVID lockdowns on machinery and equipment, artificial intelligence. Firms are investing a lot of money. That's captured in the business investment numbers. Business confidence has weakened the last 6 months, but it's in neutral zone. If we get another couple of months of weakness in business confidence, I'll move that onto the easing side soon. Commodity prices, I'm moving that to, almost to the easing cycle, because as I mentioned, the Reserve Bank index of commodity prices is down over 20% in 2 years. So the commodities that are relevant to Australia, like we don't export oil, so we don't include oil in our commodity prices. We export iron ore, wool, wheat, coal, all that sort of stuff. So they have a higher weighting. Our commodity price index, go to rba.gov.au and have a look if you want to, is where commodity prices are weak. Stock market, neutral. We're doing okay. It's, the ASX is, 700, 800. We're near a record high, but we're doing okay. No reason to hike or cut because of the stock exchange. And current interest rates are restrictive. I'm putting that not quite in the easing camp yet, but rates are restrictive. We know that, the RBA acknowledged that. And so you see this checklist. The only thing that's even vaguely close to tightening is inflation, the actual inflation number, which is lagging. You got a few that are neutral. And over the last couple of months, you've seen a movement towards the easing side.
So what that tells
as soon
us,
as this one gets to neutral or these go to easing, that's when the rate cuts. In my view, will come. And I know we're talking rate hikes, but I still think the next move is down.
so what that tells us, nothing. Don't change. No change.
So no change for August. No,
That's
no,
what it tells
no.
us. Like everything says neutral. Just stay where we are.
And the other thing that, again, I've learnt from watching the RBA, if in doubt, do nothing. Oh, should we hike? Oh, it might cause a recession. Should we cut? No, it's a bit early yet. Do nothing.
So not preemptive.
Do nothing. Correct, yes. So that's why I think, I think there's a very, very, very high probability they do nothing in August unless there's some shock economic data at the end of July. And once we get past that hump, and as we said, those high inflation numbers drop out of your run rate, and the effect of, I know it's artificial, of the electricity subsidies and rent subsidies impact headline CPI, we're going to have a headline inflation rate 2 point something. Now, yes, that's artificial. We know it's been manipulated, if that's the right word, because of the changes on some of these subsidies that people get. But from an inflation expectations point, people will think, thank goodness I can see a bit of light at the end of the tunnel on my cost of living pressures.
As will the RBA.
As will the RBA, yes. They'll acknowledge it as being, this is what caused it.
Yep.
And we're not going to automatically cut because of it. And fair enough too, that's absolutely appropriate. But it'll be one of those ones that might just change the mood a bit.
And I think that's sort of what we needed to address today, because I think what we needed to address today was people's fear that there's going to be a rate rise.
Yeah. I've never say never, but I can't see it. I look at what my colleagues and friends say who are advocates of the rate hike. I read it carefully. What have I got wrong? Why don't I agree with them? And I think it's because they tend to be downplaying some of the labour market issues. They are. If it was inflation, if inflation was the only thing in town, fine.
I agree with that, because
but it's not the only thing in town.
But it's the top
We
one,
want
the GDP and labour
jobs.
markets.
Yeah.
For me, that's the leveler.
Yep.
And you're right. If it was just about inflation, I get it.
I get it too.
If I'm the Reserve Bank, I might say I'll put one more rate rise into them, and there's no way I'll get the inflation down to where I want it. But if you put one more rate rise into us, you're going to cause a problem for the other two important ones.
These go off the board.
Yeah, and GDP will go backwards, and labour market will kick up.
We'll tank.
So my gut feeling is, anyway, we could be wrong though, mate. But
we could be wrong.
I just don't. I feel as though we're not going to be. I feel as though that you're correct, and I feel as though that there's too much doubt associated with it all.
And just by the way, the other thing that I do to double check my take on things, is actually read between the lines what the RBA is saying. As I said, we've had 2 speeches from the RBA Deputy Governor in the last 10 days or so, and he has downplayed rate hiking. He hasn't been sort of fulsome in his conversation about interest rate pressures, but he said enough for me to say they're not about to hike rates. And a couple of well-placed journalists, I'm only speculating here, I can't put my hand on my heart and say it's true, but I'm wondering whether the Reserve Bank have contacted a few journalists to sort of say, hey, just write a conversation about no urgent rate hike. So Ross Gittins, who's well respected, he's been around for 50 years or whatever, and he doesn't write about interest rates very often. He writes more about a whole lot of other stuff. He had an article earlier this week. Just go to smh.com.au and have a look at Ross Gittins, really, really downplaying the need for rate hikes. He didn't say rate cuts yet, but he absolutely put the absolute smasher on no rate hikes because we've already got enough in the system.
And I have a high respect for Ross, and I think that we're in his camp.
Yeah, I read his article and thought, gee, I like that article. Yeah, I agreed with him.
Good on you, Kooky.
Thanks, Mark.
Let's go and have some lunch, mate.
Let's have some lunch. Cheers.